Americans aren't poor. They're just unable to move anymore. Not because they don't want better jobs, not because opportunity disappeared, but because leaving now comes with a price most people can't afford. Moving used to be how people escaped stagnation. Today, it's how they lose ground. Housing didn't crash, it locked people in place. And when mobility breaks, the economy doesn't collapse, it slowly stops working.
The breaking point nobody wants to name. Right now, something fundamental is breaking in the job market, and most people are still using the wrong words to describe it. They say workers are burned out. They say people are lazy. They say nobody wants to work anymore. But none of those explanations are accurate. What we're actually witnessing is not a motivation problem, it's a structural breaking point. In 2025, the United States quietly experienced one of the worst labor years outside of a formal recession. More than 14 million jobs were lost in the background, even though the official numbers barely reflected it. Hiring didn't collapse all at once, it simply stopped recovering. And here's where the real signal appears. Last year, 93% of workers said they planned to search for a job, either to escape rising living costs or to regain lost purchasing power. This year, that number fell to 43%. That is not normal behavior in a healthy economy. When people stop looking for better work, it doesn't mean conditions improved. It means hope collapsed. Workers aren't staying put because they're comfortable. They're staying put because risk has become unaffordable. Inflation keeps rising. Housing costs refuse to fall. Healthcare and food absorb more income every year, yet wages don't move. So people do the math and realize something uncomfortable. Changing jobs no longer guarantees progress. In previous cycles, mobility was survival.
If rent went up, you moved. If pay fell behind, you switched employers. If the local economy weakened, you relocated. That mechanism no longer works. Economists now call this a hiring recession, as if it's a softer version of reality. But when job creation falls to recession-level lows while layoffs continue quietly in the background, the label becomes meaningless. Because from the worker's perspective, this feels exactly like a recession. And the psychology proves it. Surveys show that over 75% of workers plan to stay in their current job until at least 2027, not because they believe in stability, but because instability has become dangerous. When income barely covers fixed costs, even a temporary gap becomes catastrophic. So instead of moving up, people are stacking sideways. Side hustles, gig work, second jobs. Nearly 2/3 of workers now rely on additional income streams, not for growth, but for survival. This is not entrepreneurship, this is income substitution. And here's the paradox no one wants to admit. The labor market didn't become weak because people stopped trying. People stopped trying because the labor market stopped working. The system still reports low unemployment, but that number hides multiple jobs, part-time traps, and people who disappeared from the statistics entirely. This is the foundation for everything that follows. Because once mobility breaks in the job market, it doesn't stop there. It spreads into housing, into debt, into consumption, and eventually into social stability itself. And that's what this episode is really about. When people lose the ability to move for work, the damage doesn't stay in the labor market. Because jobs are not just income, they are location. And once income becomes fragile, location stops being a choice, it becomes a trap. That's where the real crisis begins. How housing broke labor flexibility. For decades, the American economy relied on one silent assumption. If opportunity moved, people would follow. That assumption no longer holds. Today, workers are not staying in place because the jobs are good. They're staying because leaving has become financially irrational. The average renter now spends more than 30% of their income on housing. In many cities, it's closer to 40 or even 50%. That leaves no margin for transition. Moving for a better job doesn't just mean higher rent. It means deposits, broker fees, overlapping leases, relocation costs, and weeks, sometimes months, of income risk. What used to be a short-term inconvenience has turned into a balance sheet shock. And homeowners aren't any freer. Over 60% of U.S. homeowners are locked into mortgages below 4%. Some secured rates under 3%. Selling that home doesn't unlock flexibility, it destroys it. A move today often means doubling your interest rate, and in many cases, paying more for a smaller home in a weaker labor market. So people stay, not because their city is thriving, not because their job is secure, but because the cost of mobility now exceeds the benefit. This is what economists call the lock-in effect. Housing, once a platform for mobility, has become an anchor.
And this is where the traditional advice collapses. Move to where the jobs are. Relocate for opportunity. Follow growth. Those ideas were built for a market where housing adjusted and wages compensated. But today, wages lag, housing doesn't correct, and interest rates punish movement. So the risk gets transferred downward. Workers absorb it. Families absorb it. Communities absorb it. When people can't move, labor shortages don't resolve. High-cost cities remain expensive. Low-cost regions remain underinvested. The economy stops reallocating itself, and instead of opportunity flowing to people, people are forced to wait where they are. This isn't just a housing problem. It's not just a labor problem. It's a system that broke the bridge between work and place and then kept pretending mobility still exists. Which raises the uncomfortable question no policy wants to answer. If workers can't move, who actually pays the price? That's where the damage becomes visible. When people can't move, the economy doesn't stop. It simply shifts the cost somewhere else. And that cost doesn't land evenly, because when housing locks workers in place, someone always pays the price. Who absorbs the shock? When people can't move, the economy doesn't freeze. It shifts the pressure somewhere else. Because when housing locks workers in place, the cost doesn't disappear. It lands quietly, predictably, on the people least able to absorb it. The housing crisis is often framed as a personal failure, a bad purchase, a late decision, the wrong city at the wrong time. But when millions of people are trapped in housing they cannot replace, this stops being about individual choices. It becomes a structural constraint. And every constrained system redistributes pressure. What changes first isn't employment, it's mobility. Workers stop moving toward opportunity, not because better jobs don't exist, but because the housing math makes relocation impossible. Leaving a stable lease or a low-rate mortgage now means accepting double the cost, higher risk, and zero margin for error. So people stay where they are, even when the job no longer works. Mobility used to be leverage. If wages stalled, workers moved. If costs rose, they adjusted location. Housing was flexible enough to allow correction. That flexibility is gone. What replaces it isn't unemployment, but endurance. Longer commutes, lower quality jobs, stacked income streams, side gigs filling the gap that wages no longer cover. On paper, employment looks strong. In reality, people are stretching themselves thinner just to avoid falling backward. Employers respond to this without saying it out loud. When workers can't leave,
Companies don't need to compete as aggressively on pay. Instead of raising wages, they break jobs apart. More contract work, more variable hours, fewer benefits. The role still exists, but the security doesn't. This is how a labor market can look healthy while income stability quietly erodes underneath. People are working, but increasingly exposed. Over time, housing pressure reshapes entire cities, not by pushing everyone out at once, but by filtering who remains. Mid-income households disappear first. Young families delay or never arrive. Skilled workers quietly exit high-cost regions or abandon certain careers entirely. What's left is not growth, but sorting. High earners who can absorb the cost, low-wage service workers who can't leave, and very little in between. None of this shows up cleanly in the data. Unemployment stays low because people can't afford not to work. Gig work counts as employment, multiple jobs look like resilience, and those who give up searching vanish from the statistics altogether. Housing pressure doesn't announce itself as a crisis. It shows up as exhaustion, and exhaustion isn't measured until behavior changes. When housing becomes the largest financial risk in a household, everything else gets postponed. Career moves feel dangerous. Education becomes optional. Entrepreneurship feels reckless. Family formation turns into a liability. People stop optimizing. They start defending. This is why productivity stalls even as hours worked remain high, why innovation slows without a single obvious trigger, why the economy keeps moving but feels heavier every year. Housing didn't just become more expensive, it became the shock absorber for the entire system. And once households are forced into that role, the next adjustment is inevitable. Because when mobility disappears and income can't stretch any further, the system reaches for the only thing left: debt. When debt stops cushioning and starts controlling. And this is where the system quietly crosses a line. Because once housing absorbs mobility and income loses flexibility, debt stops being optional. At first, it looks harmless. Credit cards smooth the gap between rent and groceries. Auto loans stretch longer to keep monthly payments manageable. Buy now, pay later fills in where cash no longer reaches. None of this feels dramatic. Households aren't speculating, they're compensating. Debt doesn't rise because people want more. It rises because they can't adjust. When housing costs lock in, expenses become fixed. Rent doesn't negotiate. Mortgage payments don't care if hours are cut. Utilities, insurance, property taxes, they all reset higher and stay there. Income, meanwhile, becomes variable. That mismatch is where credit enters the picture, not as leverage, but as insulation. For a while it works. Spending stays visible. Retail sales hold up. Services remain busy. From the outside, the consumer still looks alive. But what's actually happening is substitution. Borrowed money is replacing income that no longer grows. This is the most misunderstood phase of the cycle. Because as long as spending continues, policymakers see stability, markets see resilience, businesses see demand, but households feel pressure. And pressure changes behavior before it shows up in data. Minimum payments rise quietly. Balances stop falling between paychecks. Emergency expenses go on credit instead of savings.
Then, savings disappear altogether. Debt doesn't break the system all at once. It compresses it. Every dollar borrowed today reduces flexibility tomorrow. Future income is pre-committed to past survival. This is why delinquency always appears at the edges first. Younger households, lower-income borrowers, renters with variable hours, subprime auto loans, revolving credit. Not because these groups are reckless, but because they have no slack.
As soon as missed payments begin to rise, lenders react, not emotionally, but mechanically. Credit limits stop increasing, promotional rates disappear, approval standards tighten, risk gets repriced, and that's the moment the system flips. Because credit that once absorbed pressure now starts reflecting it. Households don't suddenly panic, they simply lose access. And when access disappears, spending doesn't decline smoothly. It drops in steps. Discretionary categories go first. Then maintenance gets delayed. Then essentials get prioritized brutally. The economy doesn't slow because confidence collapses. It slows because liquidity does. This is why downturns often feel sudden, even when pressure has been building for years. The structure holds until the mechanism supporting it is withdrawn. Housing locked people in place. Income stopped adjusting. Debt filled the gap. But debt cannot expand indefinitely. Once lenders pull back, the last buffer disappears. And when that happens, the pressure has nowhere left to go except back into the real economy, into revenues, into margins, into jobs. Which brings us to the next question, not whether the labor market breaks, but how it weakens without anyone noticing.
The housing market isn't frozen, it's locked. At this point, it's tempting to say the housing market is simply stuck. Too expensive for buyers, too risky for sellers, too tight for renters. But that word, stuck, is misleading. Because a frozen market implies something temporary, a pause, a moment waiting for conditions to improve. What we're seeing now is different. The U.S. housing market isn't frozen, it's locked. Locked by interest rates that reset affordability overnight. Locked by owners who can't sell without giving up once-in-a-lifetime mortgage terms. Locked by builders who can't profitably produce homes at prices people can actually afford. And locked by renters whose rising payments prevent them from ever saving enough to escape. This is not a supply shortage in the traditional sense. Homes exist, they're just economically inaccessible. Millions of homeowners are sitting on 2–3% mortgages, financial golden handcuffs. Selling means trading a manageable payment for one that's 60, 70, sometimes 100% higher for the same house. So they don't move, they don't downsize, they don't free up inventory. Turnover dies. At the same time, demand doesn't disappear, it compresses. First-time buyers don't stop wanting homes, they just stop qualifying. And when buyers can't buy, they rent. That pressure doesn't relieve the system, it shifts it. Landlords gain pricing power not because they're greedy, but because the market structure gives them no competition. Renters are bidding against each other for the same limited units, while ownership remains permanently out of reach. This is how housing quietly transforms from a ladder into a gate. Even new supply doesn't fix this. Most new construction today targets the top of the market, not because developers prefer luxury, but because financing costs force them there. When capital is expensive, only high-margin projects survive. So we end up with more units and worse affordability. Prices don't need to skyrocket for the system to break. They just need to stay elevated long enough for wages to fall behind and savings to evaporate. And that's exactly what's happening. Housing is no longer responding to income, it's responding to capital conditions, which means the market doesn't correct the way people expect. There's no dramatic crash, no mass capitulation, just immobility. And immobility is deadly for an economy built on movement, moving for better jobs, moving for family, moving for opportunity. When people can't move, risk concentrates. And when risk concentrates, it doesn't disappear, it waits. When housing stops the economy from moving. Housing is supposed to be the engine of mobility. It's the mechanism that allows people to move closer to opportunity, to trade space for income, to relocate when industries shift, and to reset their lives when circumstances change. For decades, housing wasn't just shelter, it was leverage. It allowed labor to flow to where productivity was highest, and that flow is what made modern economies dynamic. But when housing stops moving, the economy doesn't adapt, it stiffens. Workers don't chase better jobs anymore. They calculate, they hesitate, they stay put, because a higher salary in a new city doesn't actually mean a higher standard of living once rent absorbs the difference. Mobility, once a rational decision, becomes a financial gamble, and most people can't afford to gamble. This is how housing quietly turns into friction. You see it in job markets where positions stay open for months, not because talent doesn't exist, but because talent can't relocate. You see it in cities that claim to have labor shortages, while millions remain underemployed elsewhere. You see it when companies stop expanding geographically and instead outsource or automate, not because it's optimal, but because it's cheaper than dealing with housing constraints. Housing doesn't just affect where people live, it determines where growth is allowed to happen. And when that constraint tightens, the economy starts losing flexibility, the very trait that once made it resilient.
The damage spreads outward. Young adults delay independence not because they lack ambition, but because entry-level wages no longer clear the housing market. Family formation slows, birth rates fall, household size shrinks, even as housing costs rise. These aren't cultural shifts, they're financial responses. Older homeowners become trapped as well. Selling a home often means trading a low mortgage rate for a higher rent or a smaller, more expensive property, so they stay. They delay retirement. They hold on to space they don't need because the alternative is worse. Housing stops circulating, and with it, opportunity. This is what a locked system looks like. Everyone holding their position, not because it's optimal, but because moving backward is too risky. And here's the illusion that keeps this going. On paper, everything still works. Home prices remain elevated, mortgage defaults stay manageable, construction exists, just not where it's needed. Policymakers point to supply pipelines, zoning reform headlines, and incentive programs. Economists debate affordability as if it's a temporary mismatch. But none of this touches the core issue. Affordability hasn't disappeared because supply paused. It disappeared because housing costs detached from incomes and reattached to capital markets. Once housing becomes an asset class optimized for yield, stability for residents becomes secondary. Prices don't need to crash for damage to occur. They just need to stay high long enough for mobility to die.
And mobility is the silent casualty no one tracks. There's no monthly report for people who didn't move, no headline for jobs not taken, no statistic for risks never attempted. But over time, the cost compounds. Productivity slows because labor can't reallocate efficiently. Innovation declines because people are less willing to leave stable but stagnant positions. Inequality hardens because asset owners benefit from price stability while non-owners face rising barriers every year they wait. Housing becomes a filter, not between effort and reward, but between inclusion and exclusion. And once that filter sets, the economy doesn't collapse, it decays. Growth becomes dependent on debt instead of expansion. Consumption relies on credit instead of income. Governments spend more to stabilize outcomes rather than enabling progress. Social tension rises, not because people are irrational, but because the system no longer responds to work. This is why waiting for a housing correction misses the point. Corrections fix prices, they don't fix incentives. If prices fall without restoring mobility, affordability doesn't return, it just resets temporarily before locking again. Without aligning housing costs to income growth, any relief is cosmetic. The uncomfortable truth is this: the housing system didn't malfunction. It adapted perfectly to the incentives it was given.
Low rates rewarded leverage. Scarcity rewarded ownership. Policy rewarded asset protection over access. And the result is a market that works exceptionally well, just not for mobility. So the real question isn't whether housing will crash, it's whether an economy can remain dynamic when its foundation no longer allows people to move, geographically, economically, or socially. Because once housing stops being a bridge to opportunity, it becomes infrastructure for inequality. And economies built on immobility don't fail dramatically. They just stop moving forward.
If you made it this far, thank you for staying. These aren't easy topics, and they're not meant to provoke fear. They're meant to provoke clarity, because systems don't change when people are emotional. They change when people understand what's actually happening beneath the surface. If this analysis helped you see the economy a little more clearly, consider subscribing. Not for predictions, not for hype, but for context, for patterns that don't make headlines, and risks that only become obvious once it's too late. Leave a comment if something here challenged your assumptions, or if you see these pressures showing up in your own life. These conversations matter, not because they go viral, but because they shape how we interpret the world we're moving through. Thank you for your time, and I'll see you in the next one.